So I'd like to welcome everybody to the Collier Bristow Digital Assets Analog Regulation event, and I'm joined by some very distinguished panelists today. So from our side, I have my partner Patrick Wheeler and my colleague Imogen Jones. And chairing today's event will be Sophia Grammy, who is CSO of CryptPro, a cryptocurrency market maker. And we're also the very distinguished Phil Mocken joining us. Phil is one of the founders of Coining, who are a leading provider of crypto custody. So without further ado, I'm actually going to hand over to Sophia, who is going to chair today's event. And it's very good to see so many of you already joined us.
All right, thank you, Nigel, and hello, everybody. Yes, as you can see here, just to kick off, you have a mix of businesses and lawyers. So the goal is really to have a legal overview of what's happening on the regulatory side, but also to hear from Phil, from Garner, and from myself, how this regulatory landscape is affecting the businesses in the digital assets and in the blockchain space. And there's also a Q&A at the end of the webinar, so please feel free to ask any questions during this time. So I will start by talking about my previous business and my current business, and see how regulation is impacting us. So quick background. So on my side, I've been in the blockchain space since 2016. When I created my company called SynSwap before I moved to CryptPro. And I'm first going to talk about SynSwap because we actually did a lot of regulatory work back then, and I got to meet with a lot of lawyers, and this is how I met with Nigel, actually. So with SynSwap, we were providing post-trade solutions for OTC derivatives using blockchain technology. And really, the whole goal of SynSwap was to automate the entire life cycle of derivatives trade by embedding every single step of the post-trade workflow into smart contracts, like matching of trade, netting, compression, and so on. And so today, every single one of these steps is done by a centralized third party. And what we did was really to create a network of trading counterparties that would run these post-trade steps in a decentralized manner. And so the trading counterparties had a node in the network and were running the smart contracts to process their trades in a distributed manner without going to third parties anymore. So because we were evolving in a very highly regulated space, and we were quite early in the game, and we were dealing with cross-border transactions, I had the chance to discuss with regulators all over the world, like so the FCA in the UK, the AMF in France, the Fed, the CFTC, ESMA in Europe, and I even went to the European Commission to see how the regulators would regulate businesses such as ours, but also how blockchain technology could help the regulators to bring more transparency to the market, in our case, the derivatives market, but can be applied to other markets. And the challenge here is that by moving centralized regulated functions such as matching or netting to a decentralized network, that brings a lot of questions to regulators, because instead of regulating each one of the third parties, now you're facing a decentralized network with multiple nodes. And our positioning was to say that we're purely a software provider, and it's actually up to the nodes in this blockchain network, so the trading counterparties that are running and deploying the smart contracts, to be regulated if they wanted to run these regulated functions. And I'm saying this was our view or our positioning because up until today, it's still not really clear. And really what we experienced with SynSwap was the unclarity of regulators, because they're facing a total change of paradigm where centralized systems are now run in a decentralized way by blockchain-based businesses. And I think that today the most relevant example is decentralized exchanges, especially as we're seeing the volume growing up on these exchanges. Right now, it's not a regulated space, but I don't really see how and why this won't be regulated in the near future. But I think it's going to be very interesting to see how the regulators would approach this decentralized exchanges and regulate these nodes here, which are mostly well, retail consumers. So this was my experience with, let's say, blockchain business. And now I'm more into the crypto world and so digital assets world. And so I think the biggest question right now in the very near term in terms of regulation is regarding the FCA registration. So as you know, any UK company right now that is carrying a crypto activity must be registered by the FCA before January the 10th. And the problem is that there's been growing concerns in the industry because there's a backlog on the applications. So I'm not quite sure what's going to happen on January the 10th. For all these UK companies in the crypto world, and are we going to see the FCA pushing the deadline, or you know, just saying if you applied but didn't get the answer, it's going to be okay, or are we going to see companies ceasing their activities? I think it's still a question mark. But really, the biggest challenge in terms of regulation is the fact that the regulatory framework is not very clear. It's very difficult to get clear answers from the FCA, and the FCA has a negative stance on cryptos. So if you add Brexit on top of that into the mix, the real question is, you know, for any UK company is really just to know if it's let's say if it makes sense to run a UK-based crypto business, because the regulatory framework is different in every country, and you have jurisdictions that are more favorable to cryptos, and so that's obviously a key thing to consider when you want to do a crypto business today and when you're in the digital asset space. And I know Phil will talk about this a bit later, and we'll talk about the differences between the UK and the other countries in terms of regulatory framework. So, but this is really a big point today for the UK. All right, so I've touched upon like several regulatory points that could be challenging, both, let's say, for blockchain-based businesses, but also for crypto business. But on top of that, there's also something else that is affecting this industry today, because it's affecting every single industries, which is GDPR. And so this is my nice transition to you, Patrick, who is going to tell us more about the impact of GDPR to blockchain and digital asset companies.
Well, thank you very much, Sophia. As Sophia says, regulation of digital assets extends beyond financial services regulation, and it does include personal data regulation. So it's my task now to give you a brief overview of the main issues, and it's going to be a whistle-stop tour because you can't cover a great deal in 10 minutes, but I will do my best. So you are probably familiar with personal data being names, addresses, and telephone numbers. And you can imagine that it will include other things such as bank accounts, wallet ownership details, but it goes further than that. and it includes data whatsoever from a living individual by which that individual can be identified. So you can see that this is going to have a much wider application for blockchain transactions and smart contracts than perhaps some people realize. So I'm going to start with some general comments about the state of play of data regulation, both now and in the coming months. Since June 2018, the EU General Data Protection Regulation, the GDPR, has been enforced in the UK. And this is now part of UK national law, and it's called the UK GDPR. And so the same laws will continue to be applied after the end of the Brexit transition period. But I'm going to talk about a little bit more about Brexit later. So for any assessment of the impact of data protection regulation, you need to start with the principles. And the key principles of data regulation are the following. Data minimization, which means that businesses should only collect and process the bare minimum of personal data and only keep it for the shortest practicable time. The next principle is transparency. Businesses should be open and honest about what personal data is used and for which purposes. Accuracy, so businesses should not use or retain inaccurate data, personal data. Security and confidentiality, so measures appropriate to the business must be taken to keep data secure and to minimize the risk of unauthorized access and use. Purpose limitation, so data should only be used for the specific purpose or purposes for which it was originally collected. And accountability, businesses must document their decisions in relation to data processing activities and be ready to explain and justify those decisions to the regulator. A further regulatory requirement you may be familiar with is that breaches, any breach of these principles, must be self-reported to the regulator, the Information Commissioner's Office in the UK, the ICO, and there's a very short time limit for that. It should be reported within 72 hours of discovery. Well, the financial services sector is pretty well used to regulation, and so it's taken data regulation on board better than a number of other sectors. However, the GDP regulation dates from 2016, and in an area as fast-moving and as technologically fluid as digital assets, there are already a number of challenges which need to be addressed and which may require change in the near future. The major advantages of blockchain technology are that transactions are secure and encrypted, unchangeable, and, save in extraordinary circumstances, cannot be deleted. So this immediately gives a big tick in the security and confidentiality box. However, it creates problems for the data accuracy and data minimization requirements. So if personal data, which you will remember is any data that can identify a living individual, is written into the blockchain, then it cannot ever be changed or deleted. Now, retaining personal data beyond any reasonable period that it can be used for the purpose for which it was collected, or keeping inaccurate data and failing to update it, are both regulatory breaches. So it's important to take whatever practical steps are feasible to address this. And this is all the more important since so much of the activity is decentralized. Each entity involved in the transaction needs to consider its own obligations in relation to the personal data that it processes. Data minimization steps are likely to include separating all personal data from the blockchain transaction and having a separate, secure, updatable, and deletable storage mechanism. It may also be useful to apply pseudonymization, which is the process of assigning a code to replace personal data, which can only be unlocked by using a separate code key. Anonymization, which is the process of stripping out all personal identifiers from data, is unlikely to be useful because there will usually be a need to identify, for example, the legal owner or those with authority to undertake transactions involving digital assets stored in a wallet. However, businesses will have to recognize that separating personal data in this way brings with it its own risks and vulnerabilities under the security principle. Another practical change brought about by the GDPR was the significantly increased awareness of the rights of data subjects. while these rights haven't changed a great deal in, well, more than 20 years now, they were very little exercised until recently. In the 2020s, however, businesses in the digital assets sector must be prepared for and be able to respond promptly and effectively whenever these rights are asserted. And a failure to do so without good cause is going to be a regulatory breach. Individuals have rights of access, which are usually asserted by making a subject access request, the right to be informed about processing activity and purposes, and that's usually dealt with in a privacy notice on a website or attached to a contract, rights of rectification of inaccurate data and erasure, sometimes known as the right to be forgotten, and rights to object to or require alternative measures to be taken where data is subject to automated decision-making and profiling. What this means in practice is that digital assets businesses must have a clear understanding of exactly what personal data they need to collect and use, what purposes the data needs to be used for, how long they can keep it, and whether automated processes are applied to such data. The most practical way to keep a record of all of these various issues, as also required by the accountability principle, is by compiling a data map and keeping it updated. A further data regulation issue for digital assets businesses is that computer processing, storage, and transactional activity inevitably crosses national borders. Data transfers through the EEA and a small group of 12 other countries which have a declaration of adequacy are seamless. All other countries, however, are treated as third countries, and unless appropriate measures are put in place to protect the security and integrity of the personal data, the transfer will be unlawful, and regulatory enforcement action can be expected. Formal data processing agreements are likely to be needed. You'll probably know that the compromise agreement that the US had in place, called the Privacy Shield, has recently been declared unlawful, so all data transfers to the US now have to apply additional measures. It's going to take too long to explain what these measures are, but there is a brief outline which Collier Bristow has prepared, and it's on our website, or we can send it to you. And so finally, the B word. There are a number of Brexit uncertainties in this area. For cross-border transfers of personal data from the UK to the EEA, the position will be unchanged. There are no additional protections or requirements that need to be put in place. But sadly, that's not the case for transfers the other way, from the EEA into the UK. After the 1st of January, the UK will be itself a third country so far as the EU is concerned. So additional protective measures will be needed for the transfer to be lawful. Now, it's been hoped by the UK business community that the EU would grant a declaration of adequacy to the UK to come in effect by the 1st of January. And that would or will maintain the UK in the position that its data protection laws are deemed equivalent to the UK GDPR. And you might think, well, that must be a no-brainer because the UK has been operating under the GDPR for 2.5 years, so surely it must offer equivalent protection. Well, sadly, the reality isn't so simple. Apart from the political pressure from some member states to try to ensure that the EU doesn't find itself in as good or a better position after leaving, the EU data protection authorities are concerned about the ability of the EU security services to gain access to personal data in a way that is not transparent. So, for example, surveillance for anti-terrorism purposes. And that same issue caused problems and brought the illegality declaration for the US Privacy Shield. So unless and until adequacy is granted, businesses transferring data into the EEA from the UK will have to comply with the GDPR, as well as the UK GDPR and the Data Protection Act. If more than occasional transfer activity is undertaken, then businesses will probably need to appoint an EEA-based entity to be the data processing representative for its activities, and EEA-based entities will need to appoint a UK representative. So this is, you can see, is going to add significant administrative cost and complexity, and the sooner that we can get a declaration of adequacy, the better. So in conclusion, the GDPR is not entirely fit for purpose in regulating digital assets. And as a rapidly expanding and evolving sector, as that grows, still further problems and challenges are inevitable. However, the European Data Protection Board has clearly signalled that the GDPR is not the end of data regulation. It's not even the beginning of the end. Perhaps it isn't even the end of the beginning. And whether businesses should take comfort from that or be alarmed, well, I'm afraid that remains to be seen. Thank you.
So, good afternoon, everybody. Thank you very much, Patrick. So I'm going to talk about financial regulation. So I'm going to be picking up some of the themes that Sophia mentioned in her introduction. In particular, one of the things Sophia mentioned was how I think post-credit crunch, we went to a very centralized regulatory system. And of course, Bitcoin was, and digital assets generally were a response to that, and in fact, very much a reaction against that, and a move to a very decentralized process. So possibly this is where our thoughts in terms of whether this is analog regulation for the digital age came in, and I have to give credit to Patrick for coining that particular title. So in the UK, I'm going to talk mainly about the UK. I know there are obviously lots of different jurisdictions looking at regulation of digital assets, and I know Phil's got lots of thoughts about how we're doing compared to some of the other jurisdictions, which he's going to share with us after me, or actually rather after Imogen. So Imogen and I are effectively going to be doing a bit of a double act. I'm going to be talking about this general setup for regulation in the UK and how it affects digital assets. And Imogen's going to be talking about a recent fairly controversial pronouncement by the FCA around banning of crypto derivatives being sold to retail clients. So in the UK, the principal piece of legislation is the Financial Services and Markets Act 2000. And under that, we have something called the Regulated Activities Order. And between them, they set out the structure for regulation of financial services and digital financial services assets in the UK. And of course, to a very large degree, because we have been a member of the European Union, that is heavily influenced by MiFID and MiFID II. So, of course, when MiFID I came out, there was no concept of digital assets. Of course, MiFID II there was, but never the twain shall meet directly. So what we were left with was post MiFID II coming in at the beginning of 2018. We had very little information from the FCA in terms of what they thought of digital assets, in particular Bitcoins, Ether, and other cryptocurrencies. That has all changed now. I mean, we've certainly changed to quite a serious degree. So there have been three significant papers issued by UK regulatory and governmental authorities. And these were roughly in October 2018, the Crypto Asset Task Force, comprising the FCA, Treasury and Bank of England, issued a report, which was setting out their understanding of the crypto asset world. Following on from that, the FCA issued a consultation paper, 19.3, predictably in 2019, and that was January 2019. And they set out their thoughts on how digital assets ought to be regulated and sought input and feedback from the market. Following that, in November 2019, the FCA issued something called its Policy Statement 1922, which was the 22nd policy statement they'd issued in the year 2019. And this summarized feedback received on CP 19.3 and set out some, I guess, they're not so much law, but they are very much how the FCA sees crypto assets in the regulatory context. And so they divided crypto assets into three broad categories. These were namely exchange tokens, which they described as types of crypto assets that are usually decentralized and used as a means of exchange. And by that, what they meant were crypto coins or cryptocurrencies, so typically Bitcoin, Ether, Litecoin. These were tokens which were used for payment, effectively not dissimilar to money, but they were very clear that these were not actually money. These fall into a sort of unregulated basket in the FCA's view. Secondly, they categorized something called utility tokens. And utility tokens were all the rage a few years ago. Utility tokens were a means to provide consumers or buyers with the access to certain types of products or services offered by the issuer. There was a lot of controversy around utility tokens because there was a feeling that people were dressing up issuers as utility tokens in order to avoid regulation. And there isn't complete clarity around utility tokens and their regulatory status even now. Some utility tokens may be regulated, particularly in the payment space, and others may not be. And a particularly good example of a utility token is a stable coin or access to a service. And then the third category they created were called security tokens. And security tokens are what they sound like. These are regulated securities simply issued through the means of a digital asset. So would it be like a share or a bond, which would normally be regulated, being issued rather than being issued in a conventional manner, being issued through in a digital fashion, so effectively on a blockchain. And the FCA's view of these is these are just regulated instruments issued in another method. And the same parts of the regulated activities order regulating debt and equity would apply to them. And then more recently, and this is something which Sophia mentioned in her introduction, the FCA decided, well, basically from 10th of January 2020, the FCA decided it has become the anti-money laundering and counter-terrorist financing supervisor of the UK crypto asset businesses. And this was through an extension of the money laundering regulations in 2017, through an extension in 2019, which itself created a definition of crypto asset. And what's interesting about this definition is it's very broad. They defined a crypto asset as a cryptographically secured digital representation of value or contractual rights that uses a form of distributed ledger technology and can be transferred, stored, or traded electronically. And this is very, very broad. And what it's meant is, as Sophia has indicated, and I'm grateful to Philip Buckingham, who has responded on the chat to say so far 180 applicants have applied. I know from my personal experience that there are plenty more in the pipeline, as I've been advising several. And I think one of the things that's taken people by surprise here was just the breadth of the definition of crypto asset here, because it would cover things like stable coins relating to commodities and to really just any form of digital asset. The point of this was, I think, partly a political one, in that there was some pressure on the FCA that these newfangled digital assets are a form of money laundering, and this must be somebody must take control of this process, and somebody must know what's going on. So I think there's an element of political pressure here, but it is true to say that there have been unscrupulous users of digital assets who have used them for money laundering purposes and for terrorist financing. So it's a natural progression. One of the things I think is quite interesting is that and it's particularly around Brexit, is that the European Union itself has basically flagged that it's going to be issuing its own markets and crypto assets regulation. This is still quite a few years off, but it's going to be a really quite broad in scope. At the moment, there is with digital assets, we are in the pre-MiFID era. For those of you as old as me, you'll recall that before 2007, the financial markets, each financial market in Europe had its own regulation. And for some of us, with Brexit coming along, the UK is all suddenly about to go back 13 years into a pre-single market for financial instruments. The idea of the markets in crypto asset regulation, which is basically trailed by the EU, is to create a single market for governing what they call out-of-scope crypto asset types, and governing these providers of services, which they call crypto asset service providers. This is still at an early stage. It's going to be, I think there'll probably be a lot of discussion around it. It's part of what's known as the FinTech Action Plan of the the European Commission. Now my big question really, and it's something which I'm looking forward to discussing with Phil, is how is the UK going to cope? How are independent jurisdictions like Switzerland going to cope, and Gibraltar, all of whom have their own crypto asset regulations, and additionally Malta as well. So there's some interesting jurisdictions that come up with quite creative solutions so far. And I guess the question is, are they going to be bounced out of the water by a single European Union regulation, which is going to create a single market in much in the same way as MiFID has done for financial instruments? Or is there still a viable future for the UK and for Malta and for Gibraltar, or maybe not Malta? Malta is obviously part of the European Union, but Gibraltar, Switzerland, who are outside, to create their own systems. So we will no doubt reflect on that in quite a lot more detail when Phil comes on board, and I'm hopeful that we can have a chat and get some opinions from the audience as well. For now, what I wanted to talk about, or rather what I'd like to do, is pass on to Imogen, because there's been an interesting development recently where the FCA has, and this is an area where I think we're out of step with Europe, where the FCA has put a ban on the trading of crypto derivatives for retail clients, and this is a form of investor protection. And never forget, the FCA is a very political organisation and is under a lot of pressure to protect investors. So I'm now going to hand over to Imogen, who is our expert in this area. Over to you, Imogen.
Thanks, Nigel. So on the 6th of October, the FCA published rules which banned the sale of derivatives and exchange traded notes that include certain types of crypto assets for retail customers. And I'm going to take you through what the rule change is, why it happened, and what this means for firms and customers, as well as the reaction and the impact. So what is the rule change? Well, the FCA has banned the sale of derivatives and exchange traded notes that reference unregulated transferable crypto assets. So that's tokens such as Bitcoin, Ether, Ripple, some of the well-known tokens. And the relevant products are cryptocurrency futures, cryptocurrency contracts for differences, CFDs, cryptocurrency options, and exchange traded notes that include crypto assets. So that means that firms cannot market, sell, or distribute these products to retail customers. The ban will apply to UK headquartered firms regulated by the FCA, which includes banks, investment firms, as well as UK branches of overseas firms or EEA firms, which use the temporary permissions regime to provide services in the UK post-Brexit. And any customers with existing holdings that have them from before the 6th of January 2021 will be able to remain invested. So why has it happened? Well, the FCA went through a consultation last year and they've published their report. And they considered that the products are ill-suited for retail customers, given the potential they may suffer sudden and unexpected losses. So the FCA considers that the products cannot be easily valued by a retail customer because of the inherent nature of the underlying assets, with which they have considered difficult to value. So that's things like the crypto assets themselves, Bitcoin and Ether, etc. Similarly, they're concerned that the price movements of crypto assets and the volatility of the market can make these products more dangerous, as well as concerns in regards to the prevalence of market abuse and financial crime, such as cyber theft, which obviously we're hearing a lot about. And particularly, they're looking at the lack of legitimate investment need for retail customers to invest in these products, which I think is potentially the key part of the FCA's consideration. And that's that they saw no need in the market for consumers to be investing in these products, which were in their view an additional and unnecessary risk in an already volatile market. So when viewing it in a balance, they saw that there was a lack of legitimate need. Criticism has come against firms which have been marketing crypto derivatives. They're often crypto CFDs, and they're marketed towards young people and retail customers. And some of these campaigns have marketed the products as a simple and alternative way to own crypto assets, alternative to owning crypto assets for retail customers, which is made much easier by the trader. You may have seen these sorts of adverts on buses or on the tube, and there's been plenty on the internet. And I think that it's likely that this kind of mass market is what the FCA is trying to protect against for a complex product. So what does this mean for firms and customers? Well, if your firm carries out marketing, distribution, or selling activities in or from the UK of the relevant products to retail customers, you're required to cease these activities by the 6th of January 2021. Firms are not going to be required to close out retail customers' existing positions unless the customer asks for it, as retail customers with existing holdings are allowed to remain invested even after the prohibition comes into force, so after the 6th of January. Firms should take particular note that the FCA have said that they will be focusing their supervision on any attempts to avoid the effect of the rules by inappropriately opting up retail clients to become elected professional clients, or by moving retail customers to associated non-UK entities just as a means of getting around the rules. And this is by no means a ban on the trading or use of crypto assets by retail customers. Retail customers are still able to invest in crypto assets, it's just specifically in these products. So the reaction and the impact. As Nigel said, this has been quite a controversial ban. There's been a mixed reaction to the announcement by the FCA, and the FCA itself noted in its report that 97% of people consulted opposed the ban. However, it's unclear to what extent this criticism of the decision is more of a dislike of the FCA imposing restrictions on crypto assets than a specific response to the impact. So the UK retail investor market has not shown much interest in crypto derivatives to date. It's thought that it will not have a huge impact on the retail crypto market after the ban. Many firms such as eToro and IG have said that their business has moved away from the retail crypto derivatives market in recent years, as their crypto derivative market has centered around professional clients, and their retail clients have been investing directly in crypto. But despite this, there's been a lot of commentary on the decision. Some commentators have called it an attack on crypto assets and have vehemently defended against the FCA's comments that the underlying asset is volatile, hard to value, and difficult for retail customers to understand. And there's been defense of the Bitcoin's volatility, saying that this has decreased in recent years, but as we've seen last week, there was a rise and a drop and a subsequent rise in Bitcoin's price. And I think that begs to differ, and it's clearly still a fluctuating market. So it appears at heart to be that these responses are a criticism of crypto assets and their suitability for the masses, rather than a genuine argument against the ban. It's a backlash to regulation rather than a particular desire to preserve this part of the market. Critics have suggested that the blanket ban will have a negative effect on retail protection, as it will push traders underground and overseas, which would expose them to more risk. The FCA's response to this is that their job is to protect consumers against harmful regulated activities within their remit, and that they'll continue to advise against unregulated firms, but this is not something that they can ban against. So there is also a concern that the ban removes retail customers' ability to hedge their crypto asset position. Now, there is actually little evidence of a large market in this anyway, and that hedging is usually done by professional clients. Retail clients are more widely using crypto derivatives for speculative trading, so they are using it for more volatile uses than hedging their own crypto assets. The FCA has clearly had a balancing act to undertake, and I think that arguably it has fallen on the right side of the balance, as there does not appear to be any great public need for retail customers to be investing in crypto asset derivatives, and the market is relatively small. And this is outweighed by the potential risk to uninformed mass market retail customers who are sold crypto derivatives as an alternative to ownership without fully understanding the risk. I do think it'll be interesting to see the impact, if any, on the market after the 6th of January 2021. But I think we'll just have to wait to see what happens there. That's all from me, but if anyone has any questions, then I'd love to see them in the Q&A, and I'll pass on to Phil.
Thank you very much. Maybe I can pull up on a bit of that directly yourself. I think the decision was a wrong decision. And I think it's because of the experience of doing similar things with the FX market, and they did not impact the consumer use of FX derivatives. All they did was drive the losses higher. And so I think the consumers suffered because of the unwillingness of the regulator to properly regulate onshore. And I think the same will happen. Now, in the case specifically of the derivatives for crypto, actually derivatives perform a more useful function in the crypto space than would apply in the FX space. Specifically, they can be used to deliver cash-only contracts for difference really, And the benefit of that is that you do not have to get involved with security associated with the private key management of digital assets. So in fact, the use of derivatives or created derivatives, particularly those that are used to mimic spot markets, is in fact a great benefit to consumers, and banning them is negative to the safety features. As in other words, they do have a utility in the marketplace for retail. And the other benefit, of course, is that derivatives tend to have much better price transparency than spot markets, which are much more subject to manipulation. So in fact, subject to the instrument types, I would say the derivatives are in many ways safer for several categories of consumers. That's not to say they should be trading the stuff. That's a very unwise thing to do. But where they are, which is what they're doing, the FCA should manage that rather than abrogate responsibility to some offshore activities. Now, if I focus on what I want to talk about, which is really regulation and what where we are on it, looking about the global scene, I'll give you a little scene setter. First of all, we are a kind of regulated EMI business in the UK. We provide settlement and safeguarding services in the digital assets marketplace. We all come from a very much a capital markets background, and we've been really supportive of the kind of strong regulatory frameworks that want deployed. And we go for an institutionally compliant model that allows transitioning from traditional capital markets infrastructure into a new digital model, whatever the asset classes. And we created effectively a digital version of Euroclear. So we can deal with all classes of asset, whether they be historical securities, fiat money, or blockchain-based assets. So we're very much of the belief that the digitalization process will create a more uniform global kind of operating market operating to common high standards, and that will not be a decentralized model. And therefore, because it's going to be a global competition, there is a regulatory competition to see who is going to set the global standards for operation. And at the moment, we see the UK has fallen somewhat behind its early start. And in the middle of becoming a rule taker rather than a rule maker, which is what it historically has been. In looking at regulators, we look upon them at kind of two axes, where first of all, we look upon them as to their response to this digital world. And we see them either as setting out new frameworks in the legislative environment, or instead looking at operational interventions. And then secondarily, we'll look at them at the attitude type, and they can either be what we would call conservative, or they can be progressive. Now, in the UK, where we see, if we analyze each of these major markets, we've seen Andrew Bailey make recently defensive comments saying that he said, let me start with crypto assets such as Bitcoin, which have appeared in the last 10 years. They don't have any connection with money at all. Their value can fluctuate widely. Surprisingly, they strike me as fundamentally unsuited to the world of payments, where certainty of value matters. Now, that's his statement, very defensive, complete antithesis of the fact that 10% of the remittance values of USD to Mexico are now occurring using blockchain-based pseudocurrencies. It completely avoids the fact that the South African rand, which is a relatively major country, is more volatile than Bitcoin. And that Dash has overtaken the Venezuelan currency as the main payment method in that country. So I think he's wrong. Furthermore, we can see that the FCA has blocked the CFDs, which, as I say, is going to replicate the experience of the FX, which is that consumer interests will be impaired. Thirdly, the FCA has clarified that EMI license holders may not hold collateral in their relevant funds account that is for digital fiat or stablecoins. And as you hear, also 4 of only 180 applicants have met the authorization takeoff for crypto asset registration. I think that will be delayed. So the UK is looking pretty negative. There's no new legislative frameworks. There is a fintech review going on right now by government, which has been kicked off since July, which we've made contributions to, and we'll see how the government responds in reframing its approach to fintech. But at the moment, just judging on where it is right now, the Brexit changes, the change of governor at the Bank of England have all made the regulators in the UK much more conservative and limited to operational interventions. In EU, we have a recent statement from Vladis Dombrovskis, the European Commissioner, and his statement starts in quite contrast to Andrew Bailey: the future is digital. Much more understanding where the future is going. And in the MiCA proposals, we see that the EU is setting out a set of changes to the existing legislative framework, which might take us 2 years to implement. And that's bringing all digital assets within the regulatory boundary. It's using a risk-based model for assessing individual assets. It's mandating consistency across the EU, replacing the existing national rules. For example, Germany, Malta have been notable in setting up their own rule structures. Of course, this is a complete contrast to the USA, where all the rules are state-based. They're also going to set out a regulatory framework for the privately issued digital fiat or stable coins, which is to say they are able to be held within EMI, and gives them permission to hold stablecoin collateral at the central bank. And they're creating standards for issuance of all new digital assets of all classes. Broadly, in my view, it's very adaptive, which is to say they're not innovating. All they're doing is saying, we're going to take what's there and we're going to make it work with the existing laws, which need to be changed and updated. That's a very positive thing. They're not innovating in the sense of anticipating the changes that will result from digitalization. They're only updating the legislation to reflect the current reality. In the US, they've got a lot of interstate rivalry and a lot of legislators, individual state legislators, as well as multiple legislators within the financial services sector. So you've got at one end, New York requiring a BIT license and Wyoming creating new digital banking licenses. So at the moment, there's no way politically that any of these can create a coherency across the US. You've got state-based competition and inter-regulatory competition. You've got the CFTC recently published guidance regarding the deposit of virtual currencies by customers with FCMs. So they are setting out, this is how we propose you would do this. It is an operational intervention, not as legislative, but it is positive in nature. The Fed has been given permission to open up a sandbox, somewhat behind other central banks, but that is now starting and they're rolling out connectivity to fintechs. Then at the SEC, we find that they've just proposed to create a safe harbor for the issuance over the next 2 years of all digital assets that are not securities. The securities fall within the standard securities model. This is to kind of protect the growth of the industry. Again, it's an operational intervention. There is no legislative initiative at all of any merit going on in the US, which is likely to be successful. So they are operating at a progressive level, but they are essentially only at the operational point. And then outside of that, we can see some of the innovators. In Luxembourg, they've introduced new legislation covering the establishment of digital registrars. No one's yet applied for it, but we'll see where that goes, and we'll see whether that comes into conflict with the MiCA regulations of the EU. Switzerland has ensured that its banks are obliged to open bank accounts for the crypto industry. One of the unique places that's done that. The UK has made only very small steps towards that, as in, please explain why you haven't, not you must. And that remains one of the biggest issues for all fintech businesses, which is getting an operating bank account. Germany, Malta, Gibraltar, Abu Dhabi have all set out primary legislation for digital assets and Lithuania is competing to provide the fastest implementation of an EMI license in Europe. Historically, the UK had more EMI licenses than all of Europe put together, but that is now going to be changing. And Singapore has established a very competitive environment for obtaining the first digital banking licenses. So the UK started this digital revolution in finance and remains the centre of fintech. However, it faces a much more conservative regulator, which is facing both the uncertainty of Brexit and the potential regulatory versions and increasing competition. For ourselves, we have an EMI license in the UK and a provisional assets license in Abu Dhabi. And directionally, we see ourselves progressing licenses in Germany, USA, and Singapore. We're looking for a FISMA license to manage securities in the UK, but this is a purely defensive approach, and we would most likely use an offshore model in the interim. So that's where we are. I'm open to questions and take it back to the panel.
Okay, thank you very much, Phil. So we're now going to move on to, we've got a little bit of time left there, and I don't know how much time we have, but I think we've had some quite good questions in the Q&A and also in the chat. So the first question actually I wanted to put back to you, Phil, which is from Peter Davey, which is in the chat, which was around DEFI. How do you think MiCA is going to affect DEFI? Sorry about all the acronyms, but thoughts on that? As I mentioned, MiCA is about adapting existing legislation to the current models. My view from what I know of MiCA is that it's not going to have a big impact on DEFI, because DEFI isn't just about regulation, it's also about legal and contractual, which again is national. And I'd have to look at that a bit more careful. But my own view is that DEFI is not the future. DEFI is expensive to deliver a functionality that's not required. But that's a personal view. Okay. And we've got another. Davey has responded to you. Many commentators think it will kill DEFI. There we go. We have a difference of opinion. So on the Q&A, we've got a number of questions come in. So initially, I'm thankful to Philip Buckingham for pointing out we've had 180 applications and 4 registered firms on the registration of crypto asset firms. So I do hope that the FCA will extend the time period. Unless we really want to shoot ourselves in the foot. Do you think Brexit will have a positive, negative, or neutral impact on the UK crypto market? Interesting. I was wondering, Sophia, as a EU national working in the cryptocurrency business in the UK, what are your thoughts?
I think it's. I don't see it as a positive outcome. Well, it's for UK company, it's going to be really, now we're going to have like specific rules in the UK to follow, and it's just going to be one single regulation that is, you know, like that would be different if we would remain in the EU and have a harmonized EU legislation, as it's the case today, not in the crypto world, as you said, but in the traditional financial markets world. And so far, the FCA is not very positive for crypto, so I don't see the Brexit being a positive impact for UK businesses in this world, at least in the digital asset world. Plus, we're going to have all the you know, the problems with the passport chain, and you know, if you're based and registered and regulated in the UK, are you going to have to do the same in the EU, which is probably going to be yes. So it's just double work for businesses and for startups. It's a big work, you know, to be regulated somewhere and then apply and be regulated in another country. So no, I see that as a negative impact.
Okay, thank you. Imogen, do you have a different view?
No, I don't actually. I think it's well, in some ways it could be positive because it gives us the opportunity to regulate in our own way, which could let the UK be leading in crypto regulation. If we can make our own laws, we can maybe follow suit with places like Malta or Gibraltar. So yeah, actually, I'll change my answer. Yes, I do have a different view.
Okay. And Phil, what are your thoughts on this subject? I think I can probably guess.
Well, my recommendation to the FinTech review is that we more or less take the European MiCA proposals and implement them quicker, which will be a competitive advantage because we could probably do it faster than them. It will take them at least 2 years. If we could do it in, say, 16 to 18 months, it would probably be a competitive advantage. I don't mean wholesale, but the basic conceptual elements of them are sound. And if we could go further than that in innovating, that would be beneficial. But that is beyond regulatory. That, for example, setting up new license structures for financial institutions to anticipate the impact of digital, setting up settlement service provider licenses. There are a lot of activities that could be done that are progressive, that will anticipate market change rather than simply react to it.
Okay, thanks very much. Patrick, any thoughts from the GDPR perspective on whether Brexit is going to offer us anything at all?
Well, I'm afraid I'm probably in the camp of those who see it as a rather negative situation, in that it will just make life more complicated, as I was mentioning in my presentation. Having said that, there was some talk from the government a while ago about doing away with UK GDPR and trying to come up with some new form of regulation. I think that was a particular pet project of Mr. Cummings, of course, who is no longer in the position that he was. So that may now have been dropped. And actually trying to unpick the GDPR framework that's been put in place, frankly, would be enormously complicated. So I think we're far better off dealing with what we've got, adapting to what we've got, and in time, I'm sure people will come to terms with it. But in the short term, it's going to be more work.
Okay, thanks very much. I was just interested in Phil's thoughts. I don't know, Phil, if you saw or anybody else actually, who've seen the comments from Rishi Sunak from 9th of November, when he talked about a new chapter for financial services post-Brexit. And one of the things he mentioned, in addition to granting equivalence to EU and EA firms of financial services, which is obviously not going to be reciprocated, was around a new regulatory approach to stablecoins. And I was wondering if you could draw even the slightest bit of optimism from our Chancellor's pronouncements, or if you think it's just generally just going to make everything's going to make our life more difficult.
Well, I'm quite sympathetic to the central bank's concerns about stablecoins. And I understand that they really do have to prepare for them, and they don't actually have a regulatory remit to deal with the implications of stablecoins. So they are very right to be cautious about encouraging their development until they get a wider remit from the government, which is what the government should provide them. And as the EU has suggested with its stable coins may be held in relevant funds account in EMI central bank, that is a technical stepping stone, but it is not overall a strategic approach to the issuance of digital money.
Thanks very much. I'm just wondering, I appreciate we're slightly over time, and I've noticed we've got a slight diminution in our number of panelists. I think we might just have time for one more question. I'm just looking on the Q&A.
There's a couple of quite quick ones if you want me to answer.
Yeah, why don't you go for it, Imogen? Yes.
Well, the first one is that does the retail sale of crypto derivatives also apply to 5MLD registered firms? And yes, it does. And what will stop institutions from pushing sales before the date of the ban? There's nothing to stop them pushing them before the dates. I imagine some will probably push them towards, but a lot of the big firms have said that they've been removing their retail clients because it's been on the table for about a year. So a lot of the firms have been moving their markets away from it. I haven't seen nothing to say that they will do that, but there's nothing to stop them. And then the other part of that question is this just a way to get individuals to invest in specialised funds instead? It's not part of the FCA's policy, but it may well get people to invest in specialised funds, but I don't think that was the purpose of the ban.
It could be a result, though.
Yeah.
Could be a result for ETF providers and other professional market players, and to line their own pockets with a little bit more commission, potentially at the expense of individual investors who could go out and do it themselves. I see Phil nodding at this. I just wonder if anybody has anything further they'd like to raise, because I appreciate we're slightly over time. If not, I would like to thank everybody for attending today. I think it's been a very interesting session. I'd like to thank all my panelists. I'd also like to thank everybody who has attended and given us any Q&A to think about. So thank you very much, everybody, and wishing you all a good day.